This
Good,
meeting is being recorded.
good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with Taylor from Life Goal Investments. How you doing, buddy?
I'm doing great. Thanks so much for having me, Michael. Good to see you.
I appreciate these conversations. The first two have been so much fun. I just got to ask, you have an ETF, HOM is the ticker. I was wondering if you could tell me more about it, because it obviously plays in the, at least given the symbol, HOM plays in the real estate game. So I'd love to know more about it.
Oh, thanks so much for giving us the opportunity. Yeah. What I will do here is I will give you a little background context as to why this ETF even came to light, why the company even came to light, because this is the flagship product that caused us to think about it. So my brother is the co-founder of the firm with me. He's got 15 years of Wall Street experience to my 10. And he sits in a condo in downtown Saratoga Springs, which is just north of Manhattan, there I live. And he's got a wife who's pregnant at the time.
Okay.
And this is about a year and a half ago now. And what happens is COVID hits and he's sitting in a condo, she's pregnant, and she's going, we need to move because we're sitting in a 1,200 square foot apartment here.
Yeah. Baby
And,
coming,
he goes,
get me out.
yeah, exactly. You're right. Yeah, this is not suited for our little one to come here, little Dakota. She's beautiful. But anyway, so they start to think about, okay, build a house, buy a house, whatever it is. They decide they're going to build a house, but it doesn't matter. Building, buying, same. So what happens is he's sitting in essentially a savings account doing 0% at a time.
Yeah.
And what happens is you just start to see home prices tick up. People are getting forced out of the cities and they're starting to buy up. Millennials are coming into peak buying age, all of these things.
Yeah.
And home prices start to tick up meaningfully. And all of a sudden he sees at one point a 10% home price inflation year over year. And then it goes to 15%. And what you see is he just looks at himself in the mirror and goes, I'm not keeping pace with this savings account. I'm seeing a negative 15% purchasing power in my capital right now. What do I do to help keep pace?
Okay.
And that's why we built out the Life Goal Home Down Payment, is to help people in the situation where home price inflation is here. It's not going anywhere, in our opinion. We can talk about that if you want.
Sure.
We don't think home price inflation is going anywhere in the short term. And yet, same time, 0% is what you get on a savings account. So that's what we built that. And I'll share my screen here, Michael, if you don't mind.
Yeah, please. Let me see it.
And I'll show a couple slides here just on, again, the build out of the product. So here is, so again, American home buyers are in a crisis. So this kind of talks to what we just spoke about here, but it wraps some numbers around it. Okay. So your average savings account currently yields 0.05%.
That's awesome.
So here's a little fun anecdote. This is going to make it even better, Michael. That means your money in a savings account doubles every 1,440 years. What? I don't even know how that math works, but it does. So anyway, long term, so this is the problem we sit in. Long term, home prices go up at 5.5% per year.
Yep.
That means they double every 13 years. And right now, the Case-Shiller index just ticked off 19.2%. That means homes are doubling less than every 4 years. Wow. So how does someone deal with the situation that they currently sit in? And why is it so important? And to your audience, this is going to be no shocker, but this is something we talk about a lot. Like, home ownership is the absolute cornerstone to wealth creation in the United States and everywhere in the world. So the average homeowner has a net worth of $250,000. The average renter runs on a treadmill and never builds net worth. Yeah. And so that's why home ownership is so important. That's why so many millennials are realizing they need to start buying homes. So what does it look like? So this is the question, Michael. What is the solution? The Life Goal Home Down Payment Investment ETF. Right on the onset in the gray box here, you can see there's two goals: creating a smooth ride with limited downside. We know you can't have too much risk if you're earmarking these dollars for that home down payment. And therefore, a smooth ride's important. But the secondary portion of that is offset home price inflation. And so what does that asset allocation look like? Now, this is an actively managed multi-asset ETF. So we make the decisions on what to buy and sell. It's not passive following an index. We actually determine we want more XYZ, less XYZ. Okay. So about 70% of it falls here in this blue category, which are bonds. Now, bonds, what they do is they control the volatility and the downside capture.
Now, just I'm gonna ask questions. I'm gonna ask.
Yeah, go ahead.
Just because.
Please do.
We didn't practice this. So when you say bonds, I think most people think treasury bonds, but these could be munis. These could be. I mean, when you say bonds, there are different flavors of bonds.
Really good question. So it's going to be a combination of both high quality bonds being treasuries, being investment grade corporates, being munis. We just bought some munis in the portfolio. Those are in the portfolio. They are very, very, very low volatility, but they're also, Michael, generally more interest rate sensitive. So if it was all high quality bonds, you'd have a lot of interest rate sensitivity, which is not something you necessarily want in this environment.
Understood.
So that's a mix of high quality stuff that's really the bedrock to keep the volatility low, and lower quality stuff. Lower quality stuff is stuff like high yield, stuff like emerging market debt, stuff like lower quality mortgage-backed securities. So these yield more, and they're also less interest rate sensitive. So it's absolutely the right question to ask. But all in all, that's kind of the anchor. That 70% is the anchor of the portfolio. And then there's about 5% in commodities. So commodities, to state what they are, those are things like corn, gold, oil, etc. They obviously are helping us out right now in this inflationary environment.
Of course.
And so the inflationary environment, commodities generally do well because they're the input costs to everything that's built. And then lastly, this is where it kind of gets innovative. The last 25% of the portfolio are in stocks. And about half of that stock exposure you see here circled in red is directly in housing related stocks. Now, why would you want housing related stocks? Because if you're using this money to purchase a home down the line, what better hedge is there to home price increases than Home Depot, Lowe's, lumber company, home builders, right? I mean, Michael, if people are buying homes and therefore forcing up home prices, likely 2x4s and hammers, et cetera, at Home Depot are going to be getting bought, as well as home builders are going to be doing well because there's going to be demand for build out of new homes.
Right. But in an environment where home building made, like, I don't know for sure, I haven't looked, but I think home builders got crushed in the last 30 days or so. I think Home Depot and Lowe's probably are backing up. That just goes to selling homes maybe is retreating. Cause again, we have earnings, right? Maybe builders aren't going to be as strong. I have no idea. I haven't thought
builders are extremely interest rate sensitive historically.
Yeah.
So that's what's happened where home prices have gone up, and therefore, I'm sorry, not home prices, Fed funds rate. The Fed has raised rates, and home builders are historically very, very interest rate sensitive. We actually think, and home builders are a double-edged sword because they're great when there's a demand for homes, which there is right now, but they're also really volatile. So you have to size them in your portfolio correctly to not have them overwhelming and therefore causing a ton of volatility in the portfolio. But why we like home builders going forward, even though rates are backing up, is that we believe that there is a mass undersupply of homes in the market. And so even though rates going up will dampen some of that need, that demand, there's such an undersupply because there's been 12 years of underbuilding, and there's a 4 million housing shortage in the United States that home builders are going to continue to have a demand just because of the vast numbers that are being demanded out of them.
Well, this is also a play kind of on your thinking about the economy backing off a little quicker than I believe. Because again, I think we both agree, if you can catch the moment that the Fed changes their stance, off to the races, and home builders will be just as interest rate sensitive, probably explode, right? You have the first Fed cut. Oh yeah. Good time to be a builder.
No doubt about it. No doubt about it. And I think that, the overarching kind of thought process when it comes to the product as a whole is not necessarily, a play on any individual sector or whatever it may be. This is a broad portfolio because before this, people didn't have anything to do but put their money in a savings account.
Well, that's why I wanted to talk about the yield on the very bottom left, the 2.96. Is that your last month, or is that is that the performance from the last month and it changes?
Good question.
Or is that fixed?
That changes on a monthly basis. It doesn't change dramatically.
Sure.
But that was the payment annualized that last month paid. So again, back to the point that you just were kind of alluding to there, bank accounts yield 0.05%. Exactly. Right now, the yield on this is 2.96%. So obviously, you're not keeping pace if home prices continue to go up at 19% per year. There's no product on the planet, there's no investment on the planet that can consistently do that. But what we're trying to do here is produce that 3% yield, and then also add a couple percentage points of appreciation out of it to try to get in that ballpark of 5.5%. Because at some point things revert back to the mean.
Of
And the
course.
5.5% that I'm referencing there is the
Is the home
50-year
growth.
average
Yeah.
home price inflation.
Makes total
Right.
sense. Now,
And so here,
I don't know how ETF works, so this might be a dumb question. Can
no,
you
you're good.
can you reinvest dividends? Because I know there are some stocks that you can reinvest dividends instead of actually
Yes.
getting the 3%. You just get more shares. Can you do that?
Yep, that's exactly what we generally think people, if
Oh,
they are saving for this purchase, think it's the most logical thing to do. Again, if you thought it was logical to purchase it in the beginning,
yeah.
rather than sitting on a savings account, don't let your money sit there and roll off and sit in a money market doing the same
Okay,
thing.
but you
Reinvest
could.
it and continue to.
You could.
What's that?
You could.
Oh, you
have it.
absolutely could.
Yeah,
Yep. Yeah. So you can take dividends or you can reinvest dividends back into the product.
So both
And so
ways.
here's an interesting kind of way of looking at the next slide here, Michael, because a lot of people are like, hey, where did you come up with this asset allocation? Because it seems logical, but who's to say 70% bonds is the right amount of bonds versus 60 or 50 or whatever it might be?
Sure.
And that comes down to portfolio construction. And here's kind of an interesting way to look at things.
Ah.
Have you ever seen one of these, Michael? It's called
I
an
have.
efficient frontier.
I've seen them, not in response to this context. Yes, I'm aware
Yep.
of them, but yeah. Okay.
So an efficient frontier measures two things at the same time. It measures risk and reward.
Correct.
And so reward being return on the left axis, the y-axis, I should say, and the x-axis measures the risk. And what we're doing here is comparing stocks and bonds. So if you have a 100% stock portfolio, you show the highest risk,
Correct.
but also the highest return.
Mhm.
But on the other side, what's interesting is that a bond portfolio, 100%, shows, yes, the lowest return, but it doesn't show the lowest risk.
Interesting.
And so what's interesting is that when you bleed a little bit of stock exposure into a bond portfolio, what you actually get is higher return and lower risk than just owning bonds. And so when you think about the build out of that portfolio that just showed 70% bonds, 5% commodities, 25% stocks, what we're looking to do, as I mentioned to begin with, is create just about the lowest volatility portfolio we can and get you at the same time in line to help offset that home price inflation. So this is counterintuitive to most people. You say stocks are more risky, bonds are less risky, but yet when you put a little bit of stock exposure in with bonds, it makes it less risky than just owning bonds. Does that make sense, Michael?
Oh, absolutely. Yeah, I read your note where that came from. That makes total sense to me. Yeah.
Yeah. And then the other question we get in the last slide I'll touch on is, Michael, we get asked this all the time. They flip back to this and they're like, okay, why didn't someone just go out and build it themselves? Why don't they buy those underlying parts themselves? And we're like, well, we gave you the secret sauce, so go ahead and do it yourself, right? Don't pay us 44 basis points, 0.44% to run it. Do it on your own.
Yeah.
Well, here's the answer to that.
No thanks.
Multi-asset ETFs are incredible vehicles for the following reason. Let's look at two things. Say you're owning the exact same two different things. The first one here is you own 4 underlying ETFs.
Okay.
And at some point, your stock, bond, commodity, real estate exposure, for example, gets out of whack and one runs, and that's 30% here.
Makes sense.
You sell out of it to get it back to this 25, 25, 25.
Yeah.
Michael, what happens?
Taxes.
Taxes. Pay the tax man. Uncle Sam has his hand out there waiting for you, and you pay that capital gain tax. What's interesting is that within an ETF, we can make those exact same decisions for you, rebalancing your risk whenever we feel right for the underlying environment that we're in.
Right.
No capital gain distributed to the shareholders.
Yeah, because you're not.
This is unique to an ETF. If this exact same thing played out inside of a mutual fund, you would also be hit with taxes. An ETF is a unique wrapper that obviously shades you and keeps you out of the way of the tax man and Uncle Sam getting out there with their hand out. So I'll stop sharing now.
Well, actually, can you go back to it? Because I want to ask one more question.
Oh, yeah. Here. Oh,
I want to go back. That's okay.
But I will. Go ahead.
I want to go back to the 70, 15, that chart, that circle.
This. Are you looking at my screen now?
I am not. I'm seeing you and me.
You're looking at my ugly mug instead? Okay, here you go.
Yeah. So the last question I had is this is your, I'll call it your goal allocation.
Yep.
I'm guessing there's some variability, like
there is.
Bonds go as low as 65 and as high as 72. Can you give me color and where you've been historically with HOM?
Yeah. So this is what we call a strategic allocation.
Okay,
So think about it. Longer term is strategy, short term is tactical.
correct.
So what we look at here is our strategic allocation. What we've had here, there have been different times. This product's been in the market since last September, so not all that long a period of time.
Okay.
But what you'll see here is the market will change. And so we saw a pretty massive sell off in stocks,
Mhm.
and we had our stock exposure shrink because of it, and we
course.
rebalanced bonds back into it.
Okay.
And then also we had to go the other way at a different time as well, where we saw the bond exposure start to shrink because rates backed up, forcing bond prices down, and we sold a little stock exposure back to rebalance back into bonds. So
Okay.
this is long term. At the end of the day, it's actively managed. We're trying to keep it somewhere in this ballpark, but we can take tactical tilts in one direction or other if we do think that the Fed's going to get more aggressive
Mhm.
or whatever it may be. But I think at the end of the day, the important thing to realize is that this is not something that's meant to be a sexy investment.
No,
This
of
is meant
course.
to be an investment that's supposed to help you get to that goal at the end of the day
Mhm.
and do it in the least risky way possible. And I think that that's hopefully what millennials are looking for, as again, they're coming into those peak buying years
Mhm.
and home prices are obviously aggressively moving upwards still, causing some of them to have to put off that purchase for the future and
Mhm.
save a little bit more for that down payment. We're hoping that this is a vehicle that fills that void that hasn't been filled at this point.
So back to your story that you started off with your brother
Yep.
in Little Dakota.
Little Dakota, she's the
Yeah.
best. She's got so much hair for she's what, 8 months old, 9 months old, something like that now. For my family, you're normally bald at that point, but she has got a blonde fro going on. It's hysterical.
Good for her. Good for her. Um, so I was curious, when you built this, what did you envision your avatar being for how long your brother in this example would hold?
Wow, really good question. Really good question. So I am going to stop sharing this now, so I'm not
That's fine.
staring at it if that's okay.
Yeah, of course.
So it's the right question to ask is what's the time frame that we're looking at in order for this purchase to take place. What we realized is that there is no kind of one size fits all when it comes to that. So what we did was we looked at it and said research says it takes the average person 6.5 years
Oh, wow.
in order to save for a home down payment. They purchase right around 33 years old. So
Mhm.
they start in that kind of mid to late 20s timeframe.
Okay.
But what we also realize is that people will use this thinking a year out from now as well.
Probably,
So
yeah.
what we try to do is say, hey, anytime there's an intersection of, hey, could this be a little bit more risky for a longer term buyer, or should it not be quite as risky for a shorter term buyer? We always err on the side of caution.
Okay.
And we do that to say, hey, we don't want this to be too volatile for anyone that owns it. And what we always say, and this is a little tongue in cheek, is like, would it be potentially ideal if we made this thing in 6-month increments where we said, hey, we'll
Mm.
build one for someone that's going to purchase 6 months from now, and then the next 6 months, and the next 6 months, and that? Yes, that might be better. But at the end of the day,
Yeah.
there is nothing that's even attempting to do any of this at this point. So let's not let absolutely perfect get in the
Yeah.
way of so much better than sitting on a savings account right now. And the
Yeah.
other thing that
Because
people
when
might be doing, if they're not,
yeah, because
go ahead.
when I think about this, right, having been in this situation back in the day, like you said, the average is 6 years. I wasn't even
Yep.
really thinking about really having a home 6 years out. I think the opportunity cost of that person, like to your point, you definitely got to skew. It's like once you get a little scratch, or you have a kid, or your wife's pregnant, it suddenly jumps to the top of the line,
Right.
right? So the fact that you lean towards that more conservative side makes me feel a lot better, right? Because you're a year out, right, and you're still chunking away 20% of your savings or whatever. You don't want to see that go anywhere.
No, exactly right. And
That
so
makes
again, err on the side of caution. But this is like, the other thing we say to this though is like, this isn't just for that first time home buyer. It's also for the
true.
people that have, they're saving for that next real estate purchase that they're going to put down. And that's been where some of the bigger chunks of money have come into this product is people that we've gotten phone calls from, and not necessarily, we usually don't speak with anyone that invests, but a couple of people have called in and said, hey, I've got XYZ. I'm looking a year out from now. And,
Mhm.
I'm looking to have it invested as opposed to sit there doing nothing.
Yeah. Well, I think there's a bunch of folks in the one rental at a time community that might want to reach out and have that conversation. Do you want them to go to Instagram and DM you? How do you want them to reach out?
Yeah, you can do that, or on our website, which is lifegoalinvestments.com. There's both an email, it's info@lifegoalinvestments, as well as a phone number. So if they do want to call us, we're happy to chat with them and talk to them about how it might or might not fit their situation. Yeah, absolutely. So website, DM us on Instagram, whatever it is.
And should they ask for you specifically?
Yeah, my name's Taylor, as you may have heard at the beginning, but yeah, happy to chat with them specifically.
All right, folks, one real at a time in the community. I want to hear who's going to reach out to Taylor. Let me know how it goes, because I have a blast with him. I'm sure you'll have a fun conversation as well. Thanks, buddy.
Michael, thanks. Good to see you, man.
Take care.